Good morning friends. In today's lecture we are going to deal with Indas 16. We will continue dealing with Indas 16, and in this lecture we are going to specifically deal with depreciation, the provisions of Indas 16 with respect to depreciation. We are going to deal with para 43 to 62A of the standard. Now this part with respect to depreciation was earlier dealt by accounting standard 6, but for companies who have to adopt Indas 16, they would have to now start providing depreciation not based on AS 6, but they would have to provide depreciation based on Indas. Okay. Now let us start with the concept now. First of all, what is depreciation? We have discussed in our earlier lectures that depreciation is systematic allocation of depreciable amount of the asset over its useful life. So it's a systematic, according to a system, according to a method, we are going to allocate. That means we are going to share the depreciable amount of the asset over the useful life of the asset. What is depreciable amount? It is cost or amount in place of cost. Subtract estimated residual value, you will get depreciable amount. That amount has to be distributed over the useful life using a systematic method. That is called as depreciation. Okay. So let us start with depreciation. The first concept we have to discuss is componentization. This is a new concept. As per Indas 16, what the standard provides is any part whose cost is significant in relation to the total cost of the asset. So if there is a component or part of an asset whose cost is significant in relation to the total cost of the asset, such components have to be depreciated separately. Such components have to be depreciated based on useful life of that component, based on residual value of that component. This is a new concept which is introduced by Indas 16. Even Schedule 2 to the Companies Act provides voluntarily from 1st April 14, companies are required to follow the component approach. Mandatorily from 1st April 2015, if there is a component whose cost is significant in relation to the total cost of the asset, the depreciation has to be provided separately for that component. So this is now included even within Schedule 2 to the Companies Act. So now what is componentization? When an asset is initially recognized, the total cost of the asset is allocated to its parts, allocated to its component. That is called as componentization. Instead of capitalizing the entire cost of an asset as one item, we are going to recognize the entire cost in different components. Example, when you acquire an aircraft can be divided into, say, let us say 3 components. One is the frame of the aircraft, the body of the aircraft. Second is the engines. The third is, we can say, landing gear, and we can say one more item can be identified, control systems. So the entire cost of the aircraft would be allocated to these 4 parts: the body of the aircraft, the engine of the aircraft, the landing gear which is there, without which the aircraft cannot land, and the control panels or the controls. Now the cost has to be allocated to these 4 parts, and we are going to recognize these 4 parts as individual assets in our books, and they are depreciated based on their useful life. The body may have life in years. The landing gear may have life which is measured in number of landings. The engine life may be measurable in number of flying hours. Control equipment can again have life in based on number of years. So based on their independent lives, we are going to depreciate them separately. That is what the standard says about componentization. Okay. So we have an example here, components of a building. A building is a very costly asset for an entity, and the building can also be divided into various components. And how to deal with that, I have taken an example here. Building envelope is nothing but the foundation, the pillars, the slab, the walls. That is called as building envelope. Out of the total cost, 38% of the cost is allocated to building envelope. Life is estimated as 60 years. Electrical and lighting fittings, 11% of the total cost, life is 20 years. These are significant parts. capitalized separately, depreciated based on their respective lives. Plumbing, fire protection, elevator, 6%, 2%, 3%, life is 18 years. Their cost may not be significant when compared to the total cost, but they can be grouped based on their useful life along with miscellaneous construction. Its life is also 18 years. So we can include these 4 items under one particular we can say grouping because they have similar useful life. Then HVAC is nothing but heating, ventilation, air conditioning. 17% of the total cost, life is 15 years. Floor coverings, interior finish and design, these are again significant parts with similar useful life. They can be grouped under one group. So what we are going to do is we can divide the building into 3 groups, 4 groups. We can say building envelope, an asset, electrical lighting equipment, an asset, plumbing, fire protection, elevator, miscellaneous construction would be another significant part. HVAC, floor covering, interior design would be another part. We can say this is A, this is B, this and this together is C, and these 3 items together is D. We can divide them into 4 components and separate and account for them separately and depreciate them separately based on their respective useful life. This is what is componentization approach. Now, how to deal with treatment of depreciation. So I have calculated some depreciation. How to deal with this is very simple concept. They should be debited to profit and loss account. If the machinery has been used for production of goods, then they can be included in cost of conversion of the goods as part of production overheads. Then if the machinery has been used in construction of an asset, then in such cases the depreciation can be included in cost of the self-constructed assets. Okay. Now, depreciation actually depends upon certain factors. A, cost or the amount in place of cost. This is nothing but the revalued amount. Or B, the residual value of the asset. C, useful life of the asset. And D, method. So these are the factors which play a role in calculation of depreciation. Cost or amount in place of cost. When an asset is revalued, the revalued amount or the fair value of the asset would take the place of cost. Residual value, then useful life, method. These factors play a role in computation of depreciation. Under SLM method, we simply follow a formula: cost minus residual value divided by useful life. This is how we estimate the amount of depreciation based on SLM method. Schedule 2 does not talk about any specific method. It only provides that the depreciable amount has to be allocated in a systematic manner over the useful life of the asset. You are allowed to use either SLM method or WDV method or any other method which can systematically allocate the depreciable value of the asset over its useful life. Next, residual value. Now let us take each item one by one. Residual value. What is residual value? Suppose I have purchased an asset today. The management would estimate what would be the condition of the asset at the end of its useful life, and in that condition, if I have an asset today, what will I recover by selling it? So I know that the life of the asset is 10 years. So management would have to estimate, if today I had an asset which was 10 years old, what would I receive by selling it in the market? Is called as the residual value of the asset. But residual value has an impact on depreciation. If residual value is greater than or equal to the carrying amount of the asset, depreciation charge would become 0. In simple words, if residual value is equal to WDV, that means there is nothing left to depreciate. In such cases, the depreciation charge would become 0. But subsequently, if residual value becomes lesser than the carrying amount, residual value falls below the WDV, in such cases we can start depreciating the asset again. Now, why will the residual value increase or decrease? As per Indas 16, every year management is expected to review the residual value of the asset. And when they review the residual value of the asset, they may find that the residual value has either increased or residual value has either decreased. If residual value increases and it becomes equal to the current carrying amount of the asset, in such cases depreciation charge should become 0. That means there is nothing left to depreciate. If residual value falls below carrying amount, that means we can provide for some loss, we can start depreciating again. That is what we have to discuss about residual value. Now we come to useful life. Again, what is the useful life of the asset is a matter of judgment. The management has to use its experience and the management has to use its judgment to estimate what should be the useful life. Indicators are given in Schedule 2. Schedule 2 indicates what may be the useful life of an asset. We can use those indications, or management with the help of technical people can estimate the useful life of the asset. It is something where the management has to use its judgment. Okay. Now, the importance of useful life is the depreciable value of the asset, that is cost minus estimated residual value, or amount in place of cost minus residual value, has to be allocated over the useful life of the asset. Longer the useful life, lower would be the amount of allocation. Shorter the useful life, the higher the depreciation allocation would be. Okay. So now, how to determine useful life? What are the factors to be considered? It depends upon expected usage. The more you use the asset, the faster the life of the asset would come to an end. Wear and tear, obsolescence. See, if you use the asset only for 8 hours, we may say the life is 10 years. If you start using it for 16 years, definitely life is going to reduce. If you use it for 24 hours in a day, then the asset is expected to be depreciated in a very quick manner. Okay. Next, legal limits. Sometimes you are bound by law to use the asset only for a specific period of time. You are bound by a contract, and as per the contract you can use the asset only for specific number of years. So that means only for those years you can use the asset. That is useful life. So what is useful life? It is the period over which the entity expects to use the asset. It is the number of units which the entity expects to produce from using the asset. So it is what? It is the period over which entity expects to use. The life of the asset may be more than the useful life. Okay. Now, sometimes useful life is lower than economic life. Let us say an asset can be used totally for 10 years, but the management has a policy of using the asset only for 6 years. This we call it as useful life, and this we call it as economic life. As per the manufacturer of the asset has a total life of 10 years, but the management has a policy of using it only for 6 years because they feel beyond 6 years the cost of repairs, cost of maintenance, the efficiency of the machine reduces. Hence, to avoid all those costs, management has the policy of using the asset only for 6 years and then disposing it off. So we are going to depreciate the asset over 6 years, not over 10 years. But here, residual value will definitely be more than residual value if the asset is used completely for 10 years. Depreciable amount would be lower here, depreciable amount would be higher here in this case. So that is the difference between useful life and economic life. Now we come to depreciation method. Again, which method of depreciation should we adopt? Again, this is an area where management has to apply its judgment. Management has to use experience in selection of the appropriate method of depreciation. Now, what the standard says is, the method of depreciation should reflect the pattern in which economic benefits are consumed from the asset. So you are using an asset, and when you use the asset, you are consuming the economic benefits from the asset. So the pattern in which you are consuming the economic benefits from the asset, in that pattern you have to depreciate the asset. I'll give you an example here. Suppose there is a mining company. They are incurring significant expenditure on developmental mining. What is developmental mining? They are incurring expenditure on removing overburden. They want to remove trees, boulders, mud to reach deposit of coal, to reach deposit of iron ore. So this expenditure which is incurred for removal of overburden, removal of trees, removal of boulders, constructing some building for the purpose of mining, sinking of shafts, is incurred for development of the mine. Now this is a capital expenditure. We will call it as a mining asset. Now the asset is going to give us benefit in the form of extraction of ore. Because of incurring this expenditure, I have now access to deposit of coal. I have now access to deposit of iron ore. Now I am going to remove it. So this development expenditure would be written off, would be depreciated based on the extraction pattern. The mine will estimate how many 1,000 tons of coal or ore is there in this mine. Every year how much I am removing from it. Suppose there is a 1,000 ton iron ore. I have extracted 100 tons of iron ore during the year. So 10% of the development cost would be amortized, would be depreciated to the profit and loss account. So this is the pattern in which I am consuming the benefits. Okay. Like standard says, you can either adopt SLN, WDV, production units method, straight-line method. The depreciable amount is allocated equally over the useful life of the asset. WDV, initially the charge is more and subsequently the charge reduces. Production units method, it is based on either machine hours or based on number of units produced. We allocate the depreciable value of the asset over its useful life. But the standard clearly says that the method should not be based on revenue. So we cannot allocate the depreciable amount of the asset over its useful life based on estimated revenue which would be generated from the asset. The answer is why. The question is why we should not use revenue based model. The standard gives an explanation here. As per the standard, sales is dependent upon demand, it is dependent upon competition, it is dependent upon sale prices, it is dependent upon inflation. These factors are not representative of the pattern in which I am consuming the asset. Hence, this is not considered as an appropriate method for depreciating an asset. So, sales depends upon factors other than consumption pattern of the asset. It may not represent the way in which I am using the asset. Hence, we are not going to use the proportion of revenue for allocating depreciable amount over the useful life of the asset. Now we come to the next part, review. This is the most important part, something which is very new in India 16 when compared to our old standards. Now as per the standard, every year, that means on balance sheet date, every year management has to review the estimated life, useful life. They have to estimate the residual value, re-estimate the residual value. They also have to review the method of depreciation. And during this review, they may find that the useful life has either increased or reduced. Estimated residual value has either increased or reduced. Or they may feel that the current method is not representative of the pattern in which benefits are consumed. Or there is another method which is more representative of the pattern in which benefits are consumed. So because of this review, estimated useful life may change, estimated residual value may change, estimated the method of depreciation might be changed. Now these changes in estimated useful life, residual value methods are not considered as a change in accounting policy. They are considered as a change in accounting estimate, and you have to provide only prospective impact. That means these changes, if the estimated life changes, if the estimated residual value changes, if the method has been changed, it will have impact only on the current year's depreciation and prospective depreciation. You are not going to adjust the accounts of previous periods. Previous comparative period information would not be adjusted. We are going to provide only prospective effect. As per old standard, if there was a change in method of depreciation, we used to provide retrospective impact. But as per Indas 16, we are now only going to provide prospective impact. That means depreciation of the current year would change and depreciation of the future. We are not going to restate what has been shown in the previous periods. This is a very, very important point. Next, we come to the relationship between fair value and depreciation. Let us take an example. Suppose carrying amount of an asset is 100 crore. Fair value of the asset is 110 crore. That means today the WD of the asset is 100 crore. As per the market, in its current condition, you can still get 110 crore. Now, does it mean that we should stop depreciating the asset? The answer is no. Just because the fair value of the asset is equal to carrying amount or more than carrying amount, the depreciation should not cease. The depreciation should continue. That is what the standard says. Just because you are regularly maintaining the asset, you are continuously carrying out servicing activity, it does not negate the need to depreciate. So this is a very, very important point. Fair value of the asset will not have any impact on depreciation. But yes, estimated residual value can have an impact on depreciation. The day estimated residual value is equal to carrying amount or more than carrying amount, for that year depreciation charge would become 0. The day it falls below carrying amount, again we should start depreciating. Next, when depreciation should begin? This is the question. So the day the asset has come to the condition for intended use, for whatever intended use you have acquired the asset, the day the asset is ready for intended use, we should start depreciating the asset. Even if the asset is temporarily idle, continue depreciation. Asset has been retired from active use, but it is not held for sale. In such cases also, as per the standard, we should continue depreciation. So the day the asset is available for its intended use, commence depreciation. If the asset is temporarily idle, continue depreciation. Asset has been retired from active use, but it is not held for sale, continue depreciation. This is what the standard has to say with respect to when depreciation begins. When depreciation ceases, when should we permanently stop depreciating an asset? Now here the standard says earliest of 2 dates you have to stop depreciation, permanently stop. First, the day the asset has been classified as asset held for sale, the day you have decided to dispose of the asset, management has taken a decision and the asset satisfies the definition of an asset held for sale under Indas 105, on that day the depreciation should cease. The another date is the date the asset is derecognized from our books of account. That means it is removed from our books of account. Earliest of 2 dates, that is the date on which asset is classified as held for sale or the date on which asset is derecognized. Earliest of these 2 dates, on that date depreciation should stop permanently is what the standard says. Okay. Next, depreciation on land and building. How should we depreciate land and building? Suppose I have acquired land and building together. What the standard says is, out of the total cost, find out what is the cost allocated to land, what is the cost allocated to building. Building would be depreciated over its useful life, whereas land will not be depreciated because it has unlimited useful life. So this is the concept with respect to land and building. Land, if I have acquired only land, in such case it is not a depreciable asset because it has unlimited useful life. I have acquired land but the land has limited useful life for me, then in such cases it has to be depreciated over its useful life. This is the concept with respect to depreciation on land and building. If land and building have been acquired together, out of the total cost of the land, allocate some cost to building, depreciated over its useful life. Land, do not depreciate it. Land I have acquired, it has unlimited useful life, do not depreciate it. Land I have acquired but it has limited useful life for me, over the limited useful life you have to depreciate the land. Sometimes you have acquired land and building but you know that you are going to immediately demolish the building and you are going to develop the land. In such cases it is better to allocate the entire cost to building, not to building, only to the land. Because see, some in developmental activities you go and acquire, you want land but there is a building also standing on it. So when you buy both land and building and you know that this building is of no use for me because I am going to immediately demolish it and I am going to construct my own building. So in such cases whatever cost you have incurred, it should be allocated to the land, not to the building. Okay. So this was the discussion on how to deal with depreciation as per Indas 16. Important concepts are componentization of an asset, depreciating the asset in parts. Okay. Now there can be one question which can be raised. Sir, significant parts whose cost is significant in relation to the total cost of the asset, you are saying it can be depreciated over their useful life. What about insignificant parts? The standard has a prescription on it. As per the standard, if there are insignificant parts, the insignificant parts have to be clubbed and they have to be depreciated together, and you may use some approximation techniques. But if it is possible to depreciate insignificant parts also separately, then definitely yes, insignificant parts can also be depreciated separately. Okay. So this was the discussion on depreciation Indas 16. We covered para 43 to 62A of the standard. I hope it was useful for you. Thanks a lot.